And today the topic is really special. A lot of folks want to know the difference between tax credit and tax deduction. Of course, deduction is great because if you have a profit and you have deduction, then you have less profit. When you have less profit, then you pay less taxes. That is just so understandable. Everybody knows about that. However, tax credit is a little bit different. And the folks, and especially small business folks, and we sometimes don't have the right understanding of tax deduction versus tax credit. And when we say tax credit, folks are kind of drawing a blank and thinking, what does that mean? And does that mean I get money back? Does that mean I don't? So this webinar really just to educate you about the difference, right? The tax deduction versus tax credit. You may say that, okay, Ying, I am getting tax credit for $5,000. And is that very different from tax deduction? Yes, very different. $5,000 deduction, it is no comparison to tax $5,000 tax credit. So let's get into our today's webinar. I am in Toronto, Canada today, and folks, and I don't have the technology to really show you the beautiful Toronto, but I'll tell you that this is where I immigrate from, right? I immigrate from Toronto, Canada to US, and then Community CPA born after that. I will tell you, every time I come back to Toronto, I love the city the way it is, but talking about home, I still think Midwest is the best place to be. Even though the Toronto is really, it's a good city. It's clean, breezy. Still, I woke up last night like 2 a.m. and I hear outside just so loud. People are just like they're living their last day of life. They're crazy, and you would never hear those kind of sounds in Des Moines, Iowa, or Bloomington of Minnesota. They just don't exist. So no responsibility disclaimer required. We must say that to you just because our video, and we may be outdated with the knowledge when you look into our video, or maybe there is a misinterpretation of certain rules, and we want to make sure that we bring that to you, and you do your own study and making sure that fit you. If you have any questions, just come back to Community CPA and we'll answer that for you. All right? Now, let's talk about the credit versus deduction. I want you to kind of understand the government incentive is everywhere. When, the government, the federal government is like a person. Imagine them as a person running their business, right? This country is their business. So when things are not doing well, or when they want to push the country into a different direction, and they would put in incentives. So the incentives come largely from the money standpoint, two ways. One is the deduction, one is the credit. When we talk about deduction, that means, you can spend that money, you can reduce your profit. That's what they call deduction. So deduction would be like the mileage, right? You are familiar with that. The mileage is every year they give you a different rate. So you can use the IRS rate times the mileage, then you can deduct that. You reduce your income from that deduction. Or you can deduct food and entertainment. Remember, now there's a temporary relief on these meals. It used to be 50%, now you can deduct it 100%. The government measure to encourage people to go to restaurants to eat. So those are deductions. They are reducing your income. You make the deduction, then the profit is less, so you pay less taxes. But what is credit? Credit is different. Credit is reversing your tax liability. So in other words, if you don't pay taxes, do you have the credit? You cannot use the credit. Of course, the credit can stay with you for next 20 years for you to use, but you have to incur liability. You must owe taxes in order to have the credit, right? So some of the credit, it is what we call refundable credit. Refundable credit means what? Means that it doesn't matter whether you pay taxes or not, you get the money back. The best example would be child tax credit. Remember a long time ago, actually not so long ago, And they used to have, you have a child tax credit. When you pay income tax, you get child tax credit. If you don't pay income tax, you don't. But now the child tax credit become a refundable credit. So even if you don't owe taxes, you still got that $3,000. You still got that $3,600 when your kid is less than 6 years old, right? So those are refundable. So on the credit side, folks, there are two kinds, refundable, non-refundable. So what we're talking about here, I want you to make a difference clearly of tax credit and tax deduction. So when the government come out to give tax credit, it is a powerful incentive because whenever they give tax credit, they're aiming at people who make tax payment to the government. Now they say, you don't have to make that tax payment. We give you incentives. We let you keep that dollars. So a lot of well-doing business will take measure. They will be like, oh, yes, I'll put in a solar panel because I'm going to save 26% of my expenses, offset my taxes. So that's powerful. Just because of the solar incentive tax credit, there is 46% of increase in solar installation this year compared to 2000. So that's how this year is 2022. We have 26% of solar tax credit. I'll cover that in the later, but I want you to understand what's the main difference, right? So on the slide, you can see business tax credit is powerful incentive. The main difference between the tax credit and the deduction is that tax deductions are used to reduce taxable income. Whereas the tax credit, it directly reduces your tax liability. Business tax credit is not the same as deduction. It is used to reduce your tax income. That's business deduction. The deduction is to reduce your taxable income. And the deduction against income is related to cost of goods sold, utility, mileage, and so on, right? So an example would be, let's use a $5,000 as an example. And if you only save, if you have a $5,000 tax deduction, what does that mean? If your income is $5,000, you have $5,000 tax deduction, then 5,000 minus 5,000, then you got a zero. You don't pay taxes, right? But if you have $5,000 tax credit, that means that you actually would have maybe $50,000 income and 10% of taxes, and you're paying $5,000 taxes. This 5,000 will reverse it out. So you actually save taxes of $50,000 income. So that is a different calculation altogether, folks. Can you tell? Can you see what I mean, right? So now let's go to business tax credit. What is business tax credit? Business tax credit are an amount that companies can subtract from tax owed to the government. Business tax credit is applied against tax you owed. If you don't owe taxes, what happens? It will carry forward. It will be saved. You don't lose it. Business apply tax credit when they file their annual or quarterly tax return. So in the United States, because IRS oversees these credits, those tax credits, and so that's why IRS is the government that's responsible for making sure you claim those credits correctly. So if you get audited by IRS, they audit your tax credit. Now, which government is giving credit, right? Now we talk about tax credit and which government, which government is giving the credit. Right now, we're talking about two types of tax credit. Tax credit for income tax, tax credit for payroll tax too. Two tax credit, folks, you need to know, right? And income tax, that is the federal income tax, payroll tax, federal payroll tax. And refundable means regardless the amount you paid in, you get the dollars. Non-refundable means only if you paid in, then you get it back. Whenever you hear the word of tax credit, go through these questions. Go through the questions I was just talking about. If you hear tax credit, you want to know, is that income tax credit? Or maybe it's a payroll tax credit. So once you answer that question, it is refundable or non-refundable. So those are the two sets of questions you want to ask for every tax credit. And so now let's talk about the most popular tax credit existed in the business world, folks. Of course, this webinar, we're focusing on business, right? For the individual, who doesn't know that? Earned income tax credit, refundable, and child tax credit, refundable. So you got those tax credits. But I am talking about business. Now, healthcare tax credit. This is a big tax credit for small businesses. I want you to know. And you must have a fewer than 25 full-time employees, fewer than 25. And your average employee salary needs to be under 50,000. Average, I'm talking about average, folks. So don't think of, oh yeah, I have, 10 employees, but one paid more than 50. It doesn't matter as long as it's averaging is less than 50 or less. And you pay at least 50% of the premium, which means that if you offer a dental, vision, health care, and the premiums for each individual, each employee is probably right around 400, 500 individual. If their family is going to be over 1,000. If you pay 50% of that, then you can get tax credit of 50% what you paid. So see this example I give you. So let's say number of employees are 10. You have 10 employees, and you maybe have 20 employees, but equivalent is 10, which means that you want to make a 40 hours a week, figure out whether it's equivalent to 10, right? The 10 doesn't mean 10 bodies. The 10 just means 10 equivalent full-time employees. And the wages total is 250,000, maybe divided by 10, that's 25,000. So you qualify. It's under 50, right? Employer, you paid health premium of 70,000 total, let's say. Then you get tax credit of 35,000, my dear. Tax credit 35,000, which means that if you pay $35,000 taxes, you will get it for free. It's offset that tax due. And the 35,000, that would revert it back. That close to almost, I would assume it's 20,000. So it's almost 600,000 on the profit. That would save you that much of taxes. So you really have a huge tax credit to look into. But of course, this is non-refundable, which means that you must be paying taxes in order to get that credit. But let's say if you didn't pay taxes, you just paid $5,000. So you got your $5,000 not paid. You don't have to pay. But what happened to my $30,000 left over? It will be carried forward to next 20 years. So you have a lot of time to spend that. This is one of the things is that when we look at a company closures, sometimes the company closes and we actually look at all these carry forward benefits that you have. You don't want to lose those tax credits, right? And so you want to consider those tax credits you might have in the pipeline. And R&D tax credit is another one that really got underutilized by small businesses. A lot of times we think the R&D are for big people, the people who invent drugs, the people who are doing, engineering, all of that stuff. And if you have that happening to you, and you think you are small, you don't deserve that, wrong. R&D, it is very simplified in the claim side, and you need to know how much payroll you paid to people who does research and development. You need to know your expenses related to that. And right now, I made a list of things that doesn't qualify the R&D. So, this R&D, for example, let's go back to the previous screen, and it is also called increased research activity credit, right? What that does is, look at my example here. It says that 1,000 on supply, 100,000 on supply, and 100,000 on payroll, and related to research, okay? For example, and one example would be one of my clients, and one of my clients, they are developing a they're developing a technology. On one end, you can send in the waste material inside of this machine, and through this black box, it came out with useful chart, and black chart and the burned and powdery, so that you can mix into your soil. So that technology, when they were doing the technology, that's a research and development. And let's say it's 100,000 of supplies, 100,000 of payroll, and 6% of the 200,000, that gives you 12,000 credit, right? That's a tax credit. So it is non-refundable tax credit, but when they start selling their product, makes money, if they have to pay $12,000 taxes, suddenly that will come in to offset their tax payment, right? So that's equivalent to if they made $60,000 profit and assume they have 30% of the tax rate, then they actually got it for free. They don't have to pay taxes. So this is where the R&D, but I know that most of people will come in and go, oh, Ying, I don't know whether I qualify to do R&D. Let's just quickly go through this list, because this is the list on the IRS website. The IRS says, oh, no, you don't qualify for R&D because these are the things you cannot do. So let's go through that really quickly. Research conducted after the beginning of commercial production. What that means is after you launch that product, you did an R&D research, then you do more research for that, that don't qualify. Research adopting existing product or process to a particular customer needs. So if it is becoming a customer's particular needs, that's not research and development. Duplication of an existing product and process, of course, if you duplicate, you just duplicate, you have business expense. That's called capital expansion. That is not R&D, right? Survey and studies. Don't charge survey studies to R&D, because you do survey, customer satisfaction survey and stuff, that doesn't count, right? Research related to certain internal use, like a computer software. And if you just want to invent a time card keeping, software, no, that's not R&D. That is just something you want to figure out for your internal use. So that is one. And research conducted outside of U.S. See, outside of U.S., you pay someone to do research in China or in Russia. Well, not in Russia, but in other countries, no, and you're not gonna be able to deduct that. So sometimes I do have questions from our clients saying that I paid a bunch of money to India for research, and can I deduct that in research R&D? And so the answer is right here. For overseas, no, has to be money spent in USA. Research in social science, arts, and humanities, and so no, social science, arts, that doesn't include in there. And research funded by other persons. So if your research is already funded, or someone giving you money for that, you of course should not claim the credit again. If you incur qualified clinical testing experience, so some of those clinics are doing R&D, so they are not belonging to here. They belong to Form 8820 called Orphan Drug Credit. So, that is just say that R&D is more for other than clinical kind of research. So this is where you can kind of thinking, okay, I know those don't qualify. So what would qualify? The best practice would be that you bring that idea, you bring that thinking to your tax preparer, to your CPA firm, have them do the research and qualify you before you do that. Actually, qualification for certain credit is really important. I can't tell you how important that is, because, sometimes if you have tax preparers who are not into those kind of research, they go, oh, I can apply for you, but you need to know that you're qualified. But you yourself, who knows they're qualified or not, and that's not a good practice. You need to have qualification done on one side, then on the other side to claim that credit. That's why I'm saying qualification is even more important than you going for tax credit. Who doesn't know how to calculate 6%? Everybody know math, right? Our calculators we buy 99 cents from dollar store knows how to do math. but you really need to get that qualification in place, put that in your file, so in case you get audited and they're not going to reverse your credit, right? Work opportunity tax credit is another big one, folks. Summer is here. You know that hiring summer students, you can qualify for that. And this is big too, okay? So work opportunity credit is a federal tax credit available to employer hiring individuals from certain targeted groups, okay? And the qualified, the veterans is one, and the ex-felon, the people who come out of jail and trying to get into society, trying to get into work, they qualify. And the designated community residents, 18 to 39 years old and live in the rural renewal community or empowerment zone. And for you to know whether you are or not, the best way is to call workforce in your state. So, in California, call EDA. In Iowa, call Workforce Iowa, and in Minnesota, call DEED. So these are the people who will know, and you can find out whether this person, you use their home address, please, not your business address, your employee's home address. Ask for whether they're in the renewal county or empowerment zone, so they can qualify for that. And what happened is, if you qualify for that, and also the summer employee from is 16 or 17 years old and it lives in this area, from May 1st to September 15 are qualified for this to this credit. It's a huge credit, folks. It's 25% of the money you paid to the qualified person. Let's say if that person you paid $10,000, 25% is what? $2,500 tax credit. That is a lot of money for you, because if you pay taxes, you literally reduce that $2,500 out of your taxes. Out of your taxes much bigger than your deduction. So they really basically offset your total expense. So your 10,000 wages is actually free. You don't pay taxes. And so that's how important that is. So let's make sure that you know this one, right? Workforce Opportunity Tax Credit. And they have this little abbreviation called WOTC. I really don't know how to sound it, but then I just call it Work Opportunity Credit. And when I refer to that, and Employee Retention Tax Credit, okay? This is the one that, going back to my comments on qualification, it is so important first for you to know the qualification of this. So, at Community CPA, we actually have a team of folks who does employee retention credit work. The majority of the work is on qualification, because you want to make sure you qualify, then you will get a refund. This is a credit that you will get a refund check, and it is not an income tax credit. It is actually a payroll tax credit, because of you already run the payroll. So for sure you will get a refund. And so this is a separate check, and we just start seeing money coming back to folks who applied for ERC credit for 2020, and the money just started coming in for about 3 months now. So, if you haven't really applied for that, and if you don't know you qualify for it or not, you should check it out, because you don't want to assume you don't qualify, okay? The ERC can be claimed with respect to qualified wages paid during this time, folks, March 13, 2020 through September 30th, 2021. And no, folks, there are also people who will qualify for the third quarter and the fourth quarter of 2021 for Recover Startup Business. Recover Startup Business are businesses started on February the 15th of 2020, and after February the 15th of 2020, because it is just, during the pandemic, their business started, and if you just started business, you can automatically qualify for the ERC credit for the third and the fourth quarter of 2021. So it's called Recover Startup Businesses, and just contact your CPA firm, have them evaluate you, making sure that you also have the right to claim the ERC, even though you are a business started after the pandemic, right? The non-refundable portion of ERC is an offset to the employer's share of Social Security tax on or before June 30th, 2021, and the employer's share of Medicare tax in the third quarter, fourth quarter of 2021 as well. And it is claimed on the employer's quarterly return, Form 941, folks, through an amendment called 941X. Eligible in 2020. Eligibility in 2020 is 50% of drop in quarterly gross receipts or full partial suspension of business due to government COVID orders until after recovery to 80% in the quarter gross receipts. I know it is very wordy. I know this is sometimes folks felt like it doesn't mean anything to you. And the best way for you to overcome that and not miss your credit is to talk to the CPA firm, get them to do the eligibility study for you. Okay? Eligibility in 2021, that is the 20% drop in quarterly gross receipts and or alternative quarter test, So that's a big word as well. It just means that if you qualify for the first quarter, you automatically qualify for the second quarter. And of course, if you fully or partially suspend of your business due to government orders and you qualify, right? And recovery startup business and automatic eligible for quarter 3 and 4 on 2021. And you probably, I want to mention to folks that, the ERC credit, it is not new. ERC credit has always been there. So they're just enhanced ERC credit during the COVID time is going through 941, going through the payroll tax. But normally, the ERC credit is actually against your income tax. So, this is non-COVID ERC credit. So let's say now you got into hurricane situation and the FEMA declared and you are a federally declared disaster area. If you continue to pay your payroll on your staff, whether they work or not, you're still paying payroll, you qualify for ERC. So don't think of ERC just for COVID. ERC has always been there, and it is something that you can take advantage of if you end up in the earthquake area, the flood, hurricane, all of those things going on in today's environment, and you qualify for that, right? So the qualification, of course, in during the COVID time, the 941, that you have this $5,000 per employee in 2020. Then $7,000 per quarter per employee in 2021. But the non-COVID ERC is 40% of qualified wages and up to $6,000. So you just need to make sure that first, number one, you qualify. Number two, you let your professional calculate the dollar for you. It is not a small dollar amount. It's automatic refund because you already paid the taxes on 941 for the COVID ERC. And for the income tax credit, that's the 5884-A. That's a form you fill out for other than COVID-19. So this is non-COVID ERC. And of course, when we talk about ERC, and you want to be careful not to double dip, right? If you use the IRS fund and if you use the PPP, and if you already had other kind of the state federal funds to pay for those salaries and you don't want to claim them twice, just make sure that the government assistance can only be used once on certain expense. So don't make a duplicated claim because there will be compliance review coming in. And I always tell folks that when the economy is going going this way, like the recession, everybody is predicting a recession, federal deficit is so big, and it is a natural, very natural for the government to look into doing compliance review, making sure that everybody getting their money they should be getting, the one that they shouldn't be getting, and should refund the government and return the credit. So you want to make sure that eligibility study is your number one priority. Now, credit for employer tax paid on tips. This is a very old credit, and if you are in restaurant business and you don't know about this, I would say that you need to change your CPA firm. And this is something that really important for the folks who run your payroll, right? They need to run your payroll, classify your payroll, and know which part of the tip payment and anything you paid on tips for Social Security, and that would come back to you as a credit. And if you have a 1120S restaurant, like, you know, for 1120S tax filing, then it will show up on the K1 for you. It will reflect tax reversal on your personal tax return, right? It is reversing what? Reversing income tax. That's why I was talking about K1. But earlier, when we were talking about ERC, and those are your payroll taxes, folks. All right. So you see, when we talk about tax credit, you need to know whether it's reversing your income tax or reversing your payroll tax. Normally, tax credit is reversing income tax, but during the COVID time, the ERC came out reversing payroll tax. So that's quite special, but it is a reversal of payroll tax credit. All right. And now there's more. And a couple of more, I want you to know the credit for small employer pension plan. All right. So let's say if you are one of my clients and to reduce your taxable income, and we implemented 401k profit sharing, cash balance plan, and I have done that a lot with our clients. And when you implement that, and there is cost to you, there is a $5,000 that we can take to reverse our taxable income. That's a tax credit. So let's say if you spend $5,000 expenses for those, then we will take that $5,000. That $5,000 expenses will turn into tax credit to you. So very, very good credit to take, folks. And if you have that set up and you didn't take advantage of that, shame on you. So that is something you need to know, right? And especially when you run a successful business and you want to put in more money to the deferral to defer more income, and that's the way to do it. This is why the pension setup is even existed. And a credit for employer-provided childcare. And I actually, within our clientele, most of our clients are within 1 million to 100 million on sales. So I actually have not come across any client who had set up a employer-provided healthcare. So, you know, the expenses that you do for the childcare, that has a credit. So just so you know, if in case you want it, we can always implement that credit for you. First, we're going to be study eligibility, making sure you're eligible. Then we will calculate how much that's saving for you. Solar incentive. Solar tax credit is under ITC, under investment tax credit. This one, I actually did a separate webinar for it. If you search our YouTube channel, you'll find it. And I just did that not too long ago. And this credit is getting really popular, folks. It's 26% of your expenses. So what that means is, let's say if your business or your personal home, this is just not for only businesses, also for home. Let's say if you decided to put solar panel on your roof and you spend $100,000, let's say. And as long as you can borrow money to do that, you don't have to pay cash out. As long as the solar panel belongs to you, you can borrow money. But that 100,000 times 26,000, so 26,000 tax credit to you. If you pay $26,000 taxes, it will reverse that. But if you pay less than 26,000, then it will zero out your taxes, leaving the credit for the next year. So that is huge. It is so much going on right now, folks. That's why you see a lot of solar panel on somebody's roof. And of course, if you have a business property, you're doing that, that's also going to work. So make sure that you take advantage of this. This credit right now, the Congress only approved up to, for residential, only up to 2023, for businesses up to 2024. So it's really not a long-lasting and for sure thing kind of credit. It's just right now it's here. So if you want to do, and they only give you the credit when you finish the project. So this summer, if you really are interested in this one, you need to hurry up for this summer. Maybe they can finish that this year, then you have 26%. Next year is 22%. It's not the same rate anymore. So just so you know. And then listen to my webinar and go on to our YouTube channel. When you log on to YouTube, type in Community CPA, one word, then you will find our channel. When you subscribe to our channel, every time we have a new posting, you get a notification. And then once you go into the channel, you can actually search for solar. You type in solar, it will come out for you. So you can study that a little bit more. And then other than the federal side of tax credit, every state is having something different too. So depending on which state you are in, you can literally come into us for estimation so we can give you what your state is going to be. And I know some states really did not catch up on the federal, but I know Iowa is very good at that, and they already caught up, and Minnesota also have it, and California is a little behind. You know, California has this very different personality per se, so they don't want to be the same as federal government. When you look at every state, you will see Iowa as a good child, just always follow whatever the federal has. Iowa normally just pass their legislation and adopting the federal. And Minnesota, better, and California is just a very naughty child, and it just likes to be different. And of course, also because they're bigger, right? They have a lot more complex issues, I suppose. And I'm not a politician, so really, every time I look at politics, I always see them like a child fighting. I don't know why. I think they're just fighting like child. Maybe they are, you know, maybe just because I am not very good with it, so I see people like cat fight, child fight. It's just ridiculous sometimes. All right, so let's talk about business tax deduction. We had all of these credit, right? We talked about what? We talked about business credit, that's with ERC credit, and I think you learned that ERC credit is just not for now. It is actually forever. Whenever you got into a federal disaster situation, ERC credit comes in. But during the COVID, ERC credit become 941 amendment. Normally, it's income tax related credit, right? And then we talked about the other credit that business can take advantage of. The biggest one would be the healthcare and your research credit, and then your solar credit and your pension credit, right? The pension, putting in pension plan credit. All of these business credit, you should know, folks. Don't miss out. Even though we are small business, we still need those credits. They are not just for the large business. They're for us too, okay? And you want to know them. Business tax deduction is different. And the deduction is really a offset of your income. These expenses are usually deductible if the business operation is to make a profit. So first of all, if you are running a business, you're not profit driven, then it's not called business, not called tax deduction, because you deduct it because you are operating, wanting to make money. But does that mean you have to make money? You know, I have clients who will say that, Ying, I've been losing money all these years. Do you think I should just not, I should close it because the IRS is going to say that, why are you keep on losing money? Are you doing it as a hobby or what's going on? So that's a valid question. Folks, let me just tell you that if you have a business that keep on losing money, as long as you're not running it under Schedule C, which is a sole proprietor, you should be fine. The hobby issue only comes when you are under 1040 running Schedule C. And if you're running Schedule C, you keep on having loss, you're taking advantage of reducing your W-2 income. It's fair for IRS to come out. So is that a real business or is it's actually a hobby, right? So make sure if you really kind of thinking, oh, I don't know, I love my business. When I love my business, does that mean I'm running a hobby? I don't think so. I love Community CPA too. I love the work I do. Is that a hobby? Well, I would love to run things as a hobby. And if you have to equivalent hobby to love the business, then hobby is a business, right? But when IRS saying it's a hobby, they're saying that you are not profit driven. You just want to do what you like to do. You don't care whether you make money or not. I care. I want to make money so that way I can run Community CPA even better, bigger, right? I can reach out to more of you. And so if I have that intention, I am not a hobby. So make sure that you are not a hobby, then you can deduct your income. To be deductible, a business expense must be both ordinary and necessary. It is so vague, right? It's very subjective. But when you get audited, the auditor will say, that's not ordinary, that's not necessary, okay? But that's the auditor's opinion. Nothing wrong with them having an opinion. A lot of times, their opinion probably is right one because they've been auditing people all the time. The IRS trained them so they know what is proper, what is not. But nowadays, with great resignation, there's a lot of new auditors on IRS team. These new auditors come out, I don't think they are that experienced to really know what is ordinary and necessary, especially if they are not really coming out of a business family, they don't know. So it is up to the business owner to explain that to the auditor. And I would just say that, for example, and we have an audit, and there's a nail salon, and they bought a lot of supplies, but the supplies was under a handwritten invoice, and it will say things like not sanitation, some sort of lavender powder, and waxing liquid, and the auditor looks at that. Your nail shop, why do you need lavender scent? Is that you just like lavender scent? Or why do you need waxing? I mean, your nail shop, why do you need wax? So they don't think it's ordinary necessary. Then you have to explain, right? You can explain that, oh yeah, that's our brand. We actually had all the purple colors in the salon. So lavender scent go with the purple, right? And we have wax because we always provide additional service to the pedicure or manicure client. And after they did all their service, we have them be treated with the hot wax treatment. So when you explain, then it's ordinary necessary. So a lot of times when auditors don't understand your business, they don't think it's necessary, reasonable, they will disallow your deduction. It is important to separate business expenses from the following expenditures. I listed it because these are the ones most likely will be denied as deduction. Number one is expenses used for cost of goods sold. And remember, all your cost of goods sold has to come from your inventory. When you do purchase, you need to book that under inventory, right? They are your inventory, and those inventory really should have very consistent vendors. And it is very difficult for IRS to be okay with when you put inventory, there's somebody's name on there, and you bought a whole bunch of inventory from Ying. Ying is your accountant. Why is she providing your inventory, right? So putting on anybody's name is not good idea. Sometimes my business owner will go, I reimburse my person to get inventory. That's why it's that person's name. It's all good and dandy, but make sure you have that receipt with you, right? So that is the one that gets denied the most. Then, of course, capital expenses. Capital expenses is allowed, but it's not a deduction. You need to put that in asset. When you put that in the asset, depending on which year you are in, the depreciation rules are different. I mean, our president in the recent years, from Obama to Trump to Biden, everybody come on board and changing depreciation. It's like that's the most convenient thing to do. I don't know why, but they did. They changed depreciation so often, and you just want to put them in the capital expenditure under asset, let your tax accountant to tell you how much you can deduct, okay? But you can't put them as a deduction directly, like, oh, I reduced my profit, I reduced my income with that. And a personal expense. Come on, folks. You know it is the best to separate the business deduction from personal. It's not worth it. It's not worth it when you combine them. Because if the auditor catch you doing $1 on personal, they don't think it's an accident. They start looking at everything else. So I always tell my folks that if you are in the restaurant business, you go to a grocery store, you buy restaurant supplies, and you also buy your personal, I would use 2 credit cards. I will separate them. One of them for restaurant, I pay by restaurant, check or credit card. The other one for my personal, I pay by my personal. So always separate them. If you get audited, the auditor goes, that looks like it's personal. Then you can show them that, look, I normally separate them. Here is my personal. It is the same day, same time, I had 2 bills. So if you can do that, I promise you, you will fly through audit, no big deal. All right, when can I deduct the expense? When you can deduct an expense depends on your accounting method, right? So if you are under accrual accounting, you can deduct the expense ahead of time. You haven't paid it yet, but you can deduct it. But if you are cash accounting, you can only deduct it when the money is gone. So a lot of times, I will say that for grocery stores, and, grocery stores, normally you receive the money from your client, but you buy groceries or you buy things ahead of time, you want to be able to deduct them ahead of time because you pay them 30 days later, right? So grocery store would be a good candidate to be on accrual method. But for, for some businesses, it's better to be on cash. For example, the dental office. Dental office, you get reimbursed by the insurance. If you're on accrual, your income, you have to be counting all your income that you submitted to the insurance. What if the insurance come back with a different number? Your accounting is getting so hard, right? Because you submitted for $120, they only give you $60 back. So you want to count them as a cash expense. So you want to be cash method. Whenever I receive payment, I count that as the income. Then when expenses come, I just pay it because dental office normally has a pretty healthy cash flow, and you don't need to leveraging your cash flow. You just, when you paid it, and you will deduct it. So those are, in general, I use these 2 businesses as an example because a lot of times people file their tax returns, they don't even know what method of accounting they were using because the tax software actually defaulted to cash method anyway. So a lot of people on cash method without even knowing it. Of course, there's other method, right? Mark to market is another method, but those are so particular to day traders. So those methods are used by different professions. So in here, for general business, these 2 are the most important. All right, common type of business expense. I want to quickly go through this with you. And I know we have, our time is going to be up pretty soon. Employee pay, that's wages, retirement plan, and the rent income, interest expenses when you borrow money for business, taxes, of course, taxes, right? And then insurance. These are the most important business expenses. And the question on the deduction, we do not have, okay, here just, I want to give you that link to IRS Gov publication 535. That one talks about what can be deducted, right? And then of course, And I want you to follow Community CPA on YouTube. And if you subscribe to our channel, and you will get all of our updates for the webinar, then you can be kept up to date. And here is the message you can send to Catherine at communitycpa.com. That's our phone number. We do open on Saturdays, like today is Saturday, although I'm in Toronto, Canada, but actually our office in Midwest is open. So if you call our lines and someone will pick it up, and I think we're the only CPA firms crazy enough that open on Saturday, because most of our clients, a lot of our clients don't have time Monday to Friday. They only have time on Saturday. So Saturday becomes the way they contact us. All right, folks. And I think we covered a lot today, and I appreciate you are here listening to me. And know that today we want you to be clear with credit and the deduction. Once you know that, and you are good, and I want you to be knowledgeable with what you do on your business side. If you have any questions, you can always contact us. And know that on the business credit side, folks, it's really important for you to actually know to get the eligibility studied first, because you can easily claim credit, right? You fill in the number, the credit will calculate on the tax return. But if the eligibility is not done, and you can end up getting the credit denied by IRS. So I hope that helps you, and I will see you again on Tuesday. And thank you for watching, and I hope you give me more questions so I can do more meaningful webinars for all of you. Bye-bye.